Hello and welcome to our episode of Monday Markets. As always, we are brought to you by Woo. Links available in the description below. 2 days left until the monthly close. So let's take a look at the monthly time frame. We're still at around mid 60,000s. The volatility has been quite good, from down to 55 all the way up to 68 now. But on the monthly time frame, it doesn't really do much for us, right? So the closes have all been above the 59k level, but there's been no real push away into all-time highs. So while this monthly close is arguably better than the others because it has spiked 4 months worth of lows and is likely going to close above the level, I'm not putting too much stock into the monthly time frame per se, because technically all 4 of these monthly closes were bullish, right? Or 5 depending on how you count. This is the breakout month. This is should have been the follow-through month, retest month, retest month, retest month. So all of these closes have been testing and closing above support, but none of them have led to expansion to the upside. So maybe next month is sort of long enough, having spiked all the lows, then we get a push. But I think other timeframes are better suited for that analysis. Overall, monthly still good, but perhaps not actionable is the verdict there. Now, the weekly time frame is the most interesting. There are 2 kind of narratives at play here from a price perspective. The first narrative is that 61k, sort of 60k reclaim failed breakdown, and that's bullish. That's a totally reasonable narrative, right? So if we look at how the price action unfolded here, 60k was the range low on basically every conceivable time frame. We had a strong break and close below that level. The break was not accepted and ended up closing back inside the range. So sort of typical failed breakout. And by this point, it's already technically met its target by traveling to the other side of the range at around 70k, depending on how you want to delineate it, right? So the kind of meme standard TA level-to-level trade where you have attempted breakdown back inside the range, go to the other side, that's already more or less played out on the weekly time frame. And it's worth noting from a practical trading execution implementation perspective that the weekly time frame wasn't terribly useful for taking action on that setup, because if you look at where the earliest weekly trigger was for closing back inside the range, it was actually here. So on the weekly close 2 weeks ago, and that ended up being right around the high. Like if you took that trade mechanically, which is to say close above equals reclaim equals bullish on the weekly time frame, therefore long, then you're, currently underwater. So this is one of those instances where you have to juggle time frames. You may be getting your higher time frame signal from the weekly chart, which is to say, hey, we're trading above the weekly level, but waiting all the way for the weekly time frame to fall in line may not always be an option, and you'll have to look at the daily or even intraday time frames to take advantage of that if you want to catch the first or early portion of the move. I did mention initially that there are conflicting narratives on the weeklies. That raises the question, what conflicts with the bullish view that we failed to break below 60k and are now back inside the range? I think the argument is twofold. The first is that purely from a technical perspective, as mentioned, we've already met the objective of the failed breakdown, right? You went from one extremity to the other, it tagged the range high, so there you go. The idea has essentially played out. The other thing worth bearing in mind is that if weekly market structure is looked from a line chart perspective, there is at least a risk of the market printing a lower high in this area. And this isn't some sort of extravagant claim. It's rather sort of straightforward market structure, right? If this is our high, this is our low, this is a lower high, this is a lower low. So there's always at least a risk that the rally after that lower low results in a lower high and sort of makes its way back down to potentially make a lower low, right? So how do you mitigate that risk, or how do we sort of trade it from a practical perspective? So if we're looking to be bullish, this type of thing, there are 2 ways to invalidate bearish market structure, depending on which leg you focus on. So as we discussed moments ago, the underlying assumption of bearish market structure is lower highs and lower lows, correct? So one way, or the 2 ways in which to invalidate this, is by attacking either of the prongs. So either the lower high has to be wrong, or the lower low has to be wrong. So let's look at each of those in turn. What would it look like if the lower high is wrong? Well, that would have to come in the form of a higher high. So applying that to our chart, if we take sort of the 70k range high, depending on how you want to draw, I've just made it extra thick here to catch a bunch of levels. If the lower high is going to be wrong, then you'd want the market to make a higher high, which would result in or require a weekly break above 69.70k. At that point, the lower high is most likely no longer valid, and the bearish market structure has sort of shifted, essentially, or there's a shift in behavior at the very least. So that's option 1. The reason, one sort of additional proviso on this type of setup is that realistically, if you're taking the 69.70k breakout trade, it's less of a market structure invalidation trade and more of an all-time high range breakout trade. Now that's arguably just a technical distinction, but one worth bearing in mind. The second option to attack the risk or get rid of the bearish scenario or invalidate it would be to focus on the lower low being wrong. Now, logically, for that to be invalidated, instead of a lower low, you'd want to see a, nope, that is incorrect. I am an idiot. You'd want to see a higher low, right? So if it's a lower high, how do we get rid of it? Via a higher high. If it's a lower low, how do we get rid of it? Via a higher low. We discussed how to do this. So now let's focus on this. If we look at our weekly chart, what would be a reasonable area for the market to print a higher low? Or another way of phrasing that question is, where is there a weekly support where that would be such that the market could make a higher low instead of a lower low? Or even in more simple terms, where is weekly support before the range low? There we go. Don't have to make it that complicated. My answer is still the weekly cluster here at 63, 64K. It was useful on the retest on the way down. It was quite useful on the flip on the way up. So I think the market is still reasonably sensitive to that type of level. So we can simply add it here. So what does that leave us with? We essentially have two levels in which we could potentially do business. We could even take this cluster to give ourselves some higher time frame liberties. So for this thing to resolve bullishly, using the logic outlined here moments ago, the weekly market structure is bullish again. Trade can be found either on a breakout through 70K, and that comes with all the pros and cons of breakout trading, or on a dip to 64K that finds support and makes a higher low instead of a lower low. So those are really, from a weekly perspective, the two worthwhile trading areas at this point in the market. Higher low candidate, higher high candidate. This is much less interesting where the market is at this exact point. If we look on the daily time frame, I think there's really no difference to the weekly. It essentially complements that view. If we look at our weekly higher low candidate level, it falls into a daily area of support resistance anyway, right? This goes back to the earlier point from previous videos about if your high time frame levels are good, it'll fill in the blanks or autofill your lower time frame charts and levels for you. The 63, 64K level, we've spoken about this level before, resistance here, and now support. And the same for the range high, pretty self-evident daily range high there as well. So my focus, at least on this trading week, if I stop having family crises and actually get to trade for a little bit, would be the 63 to 64K level if the market dips as a last-ditch attempt at a higher low and the best defined support, or alternatively, albeit less likely given I'm not a particularly keen breakout trader, would be 70K plus, okay, this thing's finally going to move, the monthly's finally woken up type of setup. Everything else is, you know, I'm sure there are intraday setups and news-based setups and stuff that can be taken. You know, this 1 hour extreme, for example, I saw some traders tweeting about that and catching some knives there in very solid risk-defined trades. There's always stuff that you could find, but from a weekly show perspective, weekly on the best of weeks, I think 63, 64K, last ditch, higher low, 70 plus as market structure shift higher high. Those are your best bets. Everything else is marginally, well, or significantly less interesting from a high time frame view. On the ETH side of things, I struggle to find any interest in this thing. Maybe if ETF flows become jarring one way or another, it might become interesting. But if we just zoom out and look at this thing, it really hasn't done that much over the last few months. Even if we take a very simple view of highest close into lowest close, it's sort of support resistance ping pong at the moment. If you were to add a mid-range on top of that, the market kind of closed above, closed below, no clear signal there. If you were to look at the weekly cluster that we discussed previously, you got a bit of a bounce there. So if you're an ETH ETF bull, that's your invalidation that the market's not going to essentially stay range bound, but rather within the range start making higher lows and gradually push up towards the range high. So trading levels for ETH 31, 3200. Other than that, I think sort of lackluster response to the ETF and a bit of a weird relationship with BTC recently as well. And I mean, this type of sloping structure, you know, pump retrace type of thing, again, maybe decent for intraday trades, but higher time frame sort of market structure wise, not as much. If I had to trade one level on this thing, it'd probably be just very conveniently the 3300 daily and intraday level. That's just kind of the most recent support before the breakdown that's now being retested. If the retest is weak, which is to say if bears are weak on selling this down and the market doesn't make a lower low and gradually starts to creep back up to the level, on the long side, the most attractive trade there would be sort of a 3400 flip and give it another go towards this cluster of highs here. Absent 3400 plus, not super interesting. And in general, those of you who've watched the videos for a while now, you know that I like when support is built in these sort of diagonal clusters. more so than, in horizontal clusters, more so than these sort of diagonal clusters here. Supports generally work better if there's a lot of time and volume transacted within a clearer consolidation rather than the market sort of drifting up or drifting down. That makes for better levels on average. On the ETH BTC front, I haven't checked in a while, but I mean, sort of hanging around the lows, not too much going on there that excites me, to be honest. And again, almost a mirror of the USD price action to some extent, where, if you read in too much into the pumps and the market structure breaks or whatever, it's just essentially been a story of full retrace and bigger picture. It really hasn't moved all that much. Again, I've been away, so I am behind on my altcoins. We can take a look at Solana. That's been very strong. It seems like any narrative can be merged to become a long Solana trade, which is great for Solana traders and holders. So even at this range low, my argument was the level has been tested too many times, and if that means I miss it and it's strong, then I miss it and it's strong. And guess what? I missed it and it's strong. So that's completely fine. I don't really have any pertinent commentary at this point in time. I mean, we're so close to the all-time high, and most of the weekly levels aren't particularly relevant at the moment. I think this is more a case of Solana's made its relative strength to the rest of the market very, very clear. And now it's a matter of the market being permissive for some Solana going up, which is to say that as long as BTC, ETH don't shit the bed and drag everything down with them, your starting point for altcoin longs should probably be Solana or Solana ecosystem stuff, simply because of the way the market's been trading. But in terms of levels and stuff like that, I mean, there's nothing hugely interesting here. I mean, you could always just look at the highs of the left and say, ta-da, there's the range high. But realistically, I'm not sure that's not going to be super useful. And that's not how I look at things at the very least. Same with kind of supports. There was this 134, 135 level that looks important, but then got chopped up a little bit, so not super interested in that. And I think going back down there at this point wouldn't be a great idea. But hey, I said that last time, so who the fuck knows? So yeah, no real Solana commentary aside from even if the USD chart isn't super interesting, the relative strength is very interesting. So it's a good way to sort of, if you have a view on the market, Solana is a good way to express it. Is the best way I can think of that. Maybe you can tell me some meme coins or the ones that are listed on centralized exchanges to look at the very least. I know Popcat has been on my feed quite a bit. I think with these types of moves, you essentially you only want to trade them as long as they're good. And the first time you see any type of weakness, just get out, and it's not worth it. And I mean like real kind of weakness. I mean this sort of thing after reaching up to the high and pulling back, I don't think that's super material. This breakdown that we had a while ago wasn't accepted at all and ended up reclaiming and even retesting. I mean like whiff style weakness, not to pick on anyone. I've got nothing against the whiff type of crew, but these long period of consolidation, then breakdown, and then sort of back at the low type of thing. I mean, this thing still trades very technically, and it's very interesting in that regard. But if you're looking for this portion of a trend, there really shouldn't be any hiccups. So I think if you're short-term trading this, I would look at kind of the local extremes, 74 cents range low type of deal, and then that's it, really. With BTC, sometimes you can look at a local level, right? Pay attention to that, and even for breaks, you'll say, it doesn't really matter. There's really good high time frame levels that can give this thing another stab. With meme coins, generally, I think you should give precedence to the first/nearest somewhat reasonable high time frame level, and then be very aggressive in adjusting your views if that one breaks or doesn't go anywhere. Haven't really looked at a bunch of other altcoins. Maybe let me know in the comments, and I can have a bit of a watch list ready for the next episode of Monday Markets, whenever that is, life permitting. But it doesn't really look like I'm missing a ton on the centralized exchange side of things. Final bit of commentary on futures. If we look at quarterly basis annualized, I took a bit of a haircut on this move down. It peaked reasonably high, sort of 12-13% for what was a reasonably modest move. That's been pushed down now a little, some unwinding going on there. More pertinently, if we look at the chart, there was a really big sort of walk up in open interest during the course of this rally. Now, obviously, it's not just all directional longs, for every long there has to be a short and vice versa, but you can kind of get a sense of how much speculation there is in the market, and you can get a sense of who's being more aggressive based on the changes in funding and premiums across the board. In this instance, this ramp up was really aggressive, and some really astute commentators made that clear on Twitter as well. So if we just look at this, for example, and this is eyeballing it, but price essentially went from this low to this high is just about 4%. And the commensurate move in open interest was sort of a 14% increase. And you can see premiums during that time stayed reasonably elevated as well. There wasn't some negative funding, rally, spot premium, whatever. There was a lot of perps pushing on this. And, this is a bit disproportionate, sort of a 4% price increase for 14% of open interest, and a decent probability that a lot of those are aggressive longs. We're seeing some of that get pushed out now. It doesn't need to fully retrace. I mean, a lot of the time it does, but it doesn't need to. So what can sometimes happen, for example, is the first sort of tranche of the open interest gets wiped, and then the market kind of goes sideways, and open interest will typically do that as well, and maybe even go up a little. But then if you see funding and premiums come down a lot and start being negative during the period of this consolidation, what can sometimes happen is late shorts essentially pile in during the sideways. They push the premiums down, open interest doesn't retrace the full way, and then those new shorts get liquidated on a move higher. So if you're really low time frame pattern watching this thing, I would watch funding and open interest if the market were to go sideways. And if this thing really starts to dip and get compressed, while price just moves sideways and isn't following through to the downside, there may be a bit of a counter trend pop. More generally, Mondays in general, amazing. In general, on Mondays, when there's a weekly open drive, my presumption is to either fade that or don't chase it. On this occasion, not chasing it was good. And realistically, with the way life schedule, whatever stuff is looking like at the moment, if it's not at those 63, 64, 70 plus levels, I'm probably not going to be super interested. But there might be some nice setups on the lower time frames, given the open interest and funding dynamics we discussed just now. That's it. That's all from me. I know these videos have been sporadic and probably not as helpful as usual, given I've had real life stuff and haven't had a lot of time to either trade or stay in tune with the market, but doing my best here. Hopefully this is somewhat helpful to someone. Thank you for still watching. If you are, thank you to Woo for supporting the show somehow, and hope you all have a better weekend than mine, a great start to your week, and I'll speak to you hopefully later. Bye-bye.